Good morning, everyone. It's really a great pleasure and honor being back to Dubai. I think we spent the last 18 months doing online webinars and conferences, and we're all a bit zoomed out, so it's really wonderful to be here in person and being able to talk and interact, not online, but directly. What I want to speak about is today what's going to be the outlook about the global economy, but I would like to take a medium-term perspective, because one can get a lot lost in the daily flow of news about what's going on to the global economy next 3 months or 6 months and so on. But I want to look at the picture over the medium term because it's going to have a significant impact for financial markets. And if I have one message I want to give is the following one. We've lived for the last 30 years in what people refer to, Ben Bernanke and others, as a period of great moderation, period of time where inflation was low, growth was stable, and the volatility of growth and inflation was very low. I will argue that this regime is over, and we're going to move to a period of what I call great economic and financial instability, where those of you who are old enough like me to remember the 1970s when we had stagflation, high inflation and low economic growth, there's a risk of return to a new regime of high inflation and of stagflation as well, for reasons I'm going to try to explain. Now, let me briefly tell you a little bit about the Great Moderation, this period of time of about 30 years between 1990 until recently, where the features of it were that inflation was very low in advanced economies. Central banks were barely able to keep inflation close to their target of 2%. Economic growth was moderate, and the volatility of inflation and growth was also relatively low. Now, this period of great moderation followed the 1970s when we had stagflation, high inflation and recession, following two oil shocks in 1973 and 1979. And the reason why during the great moderation inflation was low originally is argued to be due to the fact that after the 1970s, central bank became independent. They were committed to price stability. Actually, price stability became their main target of economic policies. And most central banks in the world followed policies of either formal or informal inflation targeting, where in advanced economies, the inflation target was around 2%. Now, independent central banks certainly were one of the reasons why inflation remained low, but I think there were other more structural global factors why inflation stayed low for this long period of 30 years. First of all, we had opening up of trade and globalization that led to competition and low imports of goods and services from emerging markets to advanced economies. We had things like global supply chains that led to efficiency in production. We had just-in-time production technologies. We also had migration from poor countries to rich countries, from south to north, that increased the supply of labor in Europe, in the United States, in other advanced economies, and kept the lead on wage growth. We, of course, had massive technological innovations that increased productivity, reduced the cost of goods and services, with China, India, and other emerging markets joining the global labor supply. Think about the impact of having 2.5 billion Chinese and Indians, and on top of them, billions of others in emerging markets joining the global labor supply, keeping a lead on wage growth. We had a bulge of younger workers also in advanced economies, and we had a weakening of labor unions and of workers. And finally, we also had significant deregulation in product markets and economic and market liberalization that increased competition. Now, all of these factors led to inflation to be low, around 2% or even less than 2%. Now, not everything was rosy, of course, with the Great Moderation, and that's why right now there has been a backlash against it. First of all, economic growth in advanced economies was relatively slow, what Larry Summers called the secular stagnation. Secondly, for a whole bunch of reasons, there was also a large increase in income and wealth inequality. Third, in spite of the Great Moderation, we had a severe financial crisis with the 1990-91 S&L crisis in the US, with the dot-com boom and bust in 2000. And of course, we had the great financial crisis of 2007, 2009. During this period, there was also a worsening of global climate change that was following the economic deregulation liberalization that ensued during the Great Moderation. And finally, there was also a backlash against globalization, given the severe job losses in labor-intensive, low-value-added manufacturing in the United States, in Europe, and other advanced economies. So it was a mixed bag. Now I'm arguing that this period of great moderation is over, and now we're going to have great economic and financial instability, and we're going to go to a period of time where inflation is going to be much higher, and that has significant implication, of course, for asset prices I'm going to discuss this afternoon. And there'll be also a period of time where a bunch of negative supply shocks are going to lead potentially not only to inflation, but also to stagflation, like the 70s. Let me make the argument that is in several steps. Observation number one, if you look at the stocks of debt in the global economy, and I'm putting together the sum of public debt and private debt. And by private debt, I mean the debt of the household sector, of the corporate sector, and of the financial system. In 1970, the global debt for advanced economies and emerging markets as a share of GDP was only 100%. By 1999, this number was 220% of GDP. In 2019, before the COVID crisis, this number was 360% of GDP. In advanced economy, this number was, in 2019, 420% of GDP. In China, was 330% of GDP. And in a typical emerging market that borrows mostly in foreign currency, the number was 250% of GDP. And these are numbers 2018. Since then, because of the COVID crisis, global debt has gone up, estimated, we don't have the latest number, by probably another 30% of GDP. Now, in addition to explicit debt, we also have implicit debt. If you look at the unfunded liabilities of the public sector coming from pension systems or from healthcare, they're probably around, on average, 100% of GDP, so similar to the stock of public debt. We also have huge budget deficits in advanced economies that are structural today. They're not anymore temporary, they're structural. Now, how are we going to reduce this debt and deficits? Are we going to reduce government spending as a share of GDP? Politically, just everything is going in the opposite direction. Are we going to increase taxes, significantly reduce these deficits? Mission impossible, both politically and economically. If you raise too much taxes, of course, you disincentivate economic activity. So, what's the path of least resistance? The path of least resistance is to monetize large fiscal deficits. In the short run, that leads to asset inflation, but over time, it leads to inflation. And since there is a large stock of public debt and private debt at fixed interest rates in nominal term, unexpected inflation can wipe out the real value of this debt. Now, people say, don't worry, central banks are committed to price stability. That's their main goal. I will argue that's not anymore the case. There has been a mission creep in the last decade in central banks, both in terms of their targets and goals and in terms of their instruments. Look at the goals. 20 years ago, central banks were committed only to one target, price stability. But now increasingly, some of them, former like the Fed, have also a second target, that is maximum growth or maximum employment. Third, now, they care about financial stability, but this financial stability goal means a bias towards easy monetary policy, because when the bubbles are forming, they don't lean against the wind, and when the crash occurs, of course, they backstop everybody, banks, household, corporates, and the government sector. So that leads also to loose monetary policy. Now central banks have also an average inflation targeting objective that says that if inflation is below target in a recession, we're going to go above it. They also react now to shortfalls of employment relative to maximum more than overshoots. They want to pursue what the Fed says a hot labor market. They also care about something else. They care about income and wealth inequality. The Fed today has a formal target of having a broad and inclusive employment target. That means I care about income and wealth inequality. And finally, increasingly, central banks care also about the global climate change. They're going to start financing even green bonds. So we started with one target. Today we have 6 or 7, many of them incompatible with each other. Mission creep also on instruments. Before the global financial crisis, as you know, monetary policy was banal. You had a short-term overnight policy rate, Fed funds rates in the US, and you did open market operation. That's it. During the global financial crisis, we created terms that did not even exist in macroeconomic textbooks before the global financial crisis. We had heard about things like zero interest rate policy, negative interest rate policy, forward guidance, quantitative easing, credit easing, backstops of banks and non-banks. And during the COVID crisis, not only we went back to the same unconventional monetary policy like during the GFC, but now people talk about helicopter drop of money, modern monetary theory, permanent debt monetization. And I would say the next step most likely is going to be when cash is phased out and we're going to create central bank digital currencies, as is going to happen in the next few years, then the central banks can go even more negative in the policy rate. Today, they cannot go very negative because people will switch from excess reserves into cash. Once cash is gone, you can go to -1, -2, -3, -4. So massive mission creep both on the goals and on the instruments. Additional point, economists often worry about the fact that central banks can be in what is referred to as fiscal dominance, that if there is too much debt in the public sector or deficits, in the game of chicken between the central bank and the treasury, the central bank has wimped out and has to finance large deficits. I would argue today that this is not just a problem of fiscal dominance, but central banks are in a debt trap. There is so much private and public debt that if central banks were trying to react to a rise in inflation by tightening monetary policy, there will be severe financial consequences. Meaning, suppose that the recent rise in inflation is not temporary, but is more persistent. There are two options for the central bank. Either exit unconventional monetary policy, raise rates, and then cause a crash in the bond market, a crash in the credit market, a crash in the stock market, and a crash in the economy. Or alternative, keep on monetizing debt and deficits and eventually cause inflation and wipe out the real value of nominal debt through unexpected inflation. I will argue that the latter choice is going to be the path of least resistance politically, because today there is no Paul Volcker who is willing to break the back of inflation expectations. Additional point that I think is important. I said while on the aggregate demand side, loose monetary, fiscal, and credit policy is going to be inflationary. But as you remember, in the 1970s, we had not only inflation, but we also had stagflation. Stagflation caused by two negative supply shocks, the oil spike that occurred after Yom Kippur War of 73 and after the Iranian Revolution of 1979. Now, the pickup in inflation actually occurred before these two oil shocks. In the 60s, we had loose fiscal policy in the US because of the Vietnam War and the Great Welfare Society, and by 1971, when off gold, monetary policy became loose, and therefore, even before the shock of 73, inflation was rising. And of course, the policy response to the oil shock led to inflation and to stagflation. Today, as you know, if you look at the data, we are already in a mild stagflation. In the third quarter of this year, growth in the US, in Europe, in China has gone south, much worse than expected, and inflation has been much more than expected. Now, people say, well, this is driven only by short-term supply bottlenecks in production, in labor market, in global supply chains, in transportation. But look at the data. We have a rise in inflation well above targets in goods, in commodities, in energy, in food prices, as we reopen the service sector also in services, in rent and housing, and now there is a pickup in wage inflation in advanced economies, and there is a risk of a beginning of a wage price spiral. So we are already in a mild stagflation. But my argument is as follows. In my view, over the medium term, I'm not talking about the next 6 months, there are at least 9 potential negative supply shocks that if they do materialize, they will reduce potential growth, they will increase the cost of production, and if there is loose monetary and fiscal policy because of a debt trap, they're going to lead not only to inflation, but also to stagflation. Let me summarize these 9 supply shocks in brief. Number 1, we have now a process of deglobalization and of protectionism. and inward-oriented policies, where every country is trying to protect their own firms and their own workers. There are restrictions to trade in goods, in services, in capital, in labor, in data, in technology, in information. Secondly, there's now a process of reshoring of manufacturing from China to Europe and the United States, and a balkanization of global supply chains. Partly is politics, partly is the consequences of the COVID crisis. Three, we have aging of populations, not only in advanced economies, US, Europe, Japan, but also in key emerging markets, China, Russia, Korea, and a good chunk of East Asia. And that's going to also reduce the supply of labor and lead to a pickup in wage growth. Number four, we have now restriction to migration, as I said, from south to north and from poor to rich countries. And the increase in the supply of labor coming from migrants in Europe and the United States was one of the factors that kept the lead on wage growth in the last 20 or 30 years. Number five, unfortunately, because of geopolitics, there's now a Cold War between US and China, and this Cold War is going to become colder. There's a beginning of decoupling in trade, in technology, in investment, in data and information. And I'll give you two examples of why this is stagflationary. Suppose that the West decides to build their own 5G telecom system, not based on the 5G of Huawei, but the one of European, Ericsson and Nokia. The European system costs 30% more than Huawei and is 20% less productive. So to create the same 5G system is going to be 50% more expensive in the West. Another example, 50% of all semiconductors in the world are produced in Taiwan, 80% of the high end. And there's a risk that there will be some geopolitical conflict on that. That's already leading to bottlenecks in supply, raising the cost of production, and reducing the supply of car, consumer electronics, and things of that sort. Sixth factor, global climate change affects stagflation in at least two ways. First of all, you have desertification, lack of water, droughts, and that's leading to a rise in agricultural and food prices. Now, this is not just a problem in sub-Saharan Africa or in parts of the Middle East. Look at the United States, where now in the West there is a massive drought. In California today, 1/3 of all vegetables and 2/3 of all fruits and nuts are produced in California. There is a massive 30-year drought. People are fighting on water resources. Crops are not being planted because for some farmers it's more beneficial to sell their water rights to somebody else. Other aspects of it that has to do with global climate change. We're now decarbonizing. There's been a massive underinvestment in fossil fuels. It's become politically incorrect to finance anything to do with, say, coal or natural gas or oil. So the supply of carbon or fossil fuels is going to fall, but unfortunately the increase in the supply of green energy and alternative energy and renewable is not increasing fast enough. So the supply of energy is falling, the demand is rising, and guess what? You've already Brent at 83, and people expect it to go above 100. So that's a massive problem, and we have now massive energy problems in UK, in US, rest of Europe, in China, in India, and all over the world. Seventh factor, global pandemics. Global pandemics are negative supply shock that leads to self-reliance for essential materials like food, pharma, PPE, rare metal, supply chains inputs. There is a demise of just-in-time production with low inventory. There are export controls. And unfortunately, for a number of reasons, including global climate change, these pandemics are going to become more frequent because these zoonotic diseases that transfer from animal to human have to do with global climate change. As you destroy the animal ecosystem, those animals that have pathogens like pangolins and bats are closer to livestock, are closer to humans. That's why in the last 30 years we had what? HIV, SARS, MERS, swine flu, bird flu, Zika, Ebola, COVID-19. When is going to be COVID-22 or 23? Unfortunately, these things are going to happen more frequently. Factor number 8, cyber attacks. Every other day there is an attack against some production. One day is a pipeline in the United States, the next day is a beef processor, and that reduces, and there'll be thousands of these attacks. So either supply is going to be constrained or if firm and government have to spend money to protect themselves against this cyber attack, it's going to cost them hundreds of billions of dollars, if not trillions, to prevent these shocks from occurring. Factor number 9, there is now a backlash against income and wealth inequality. This leads into policies that are pro-labor, pro-union, and pro-wages. Look at the United States. The first Biden fiscal package was passed in March, $1.9 trillion. 90% of it went to whom? Workers, unemployed, partially employed worker, minority, all those left behind. It's the beginning of a backlash against capital, of policies pro-labor that are going to lead to an acceleration of wage growth and a beginning of a price-wage spiral. So we are at the beginning of a situation that is going to lead to these supply shocks, and we lose monetary policy and fiscal policy leads not only to inflation, but to stagflation. Two final points I'll make to conclude. Point number 1, in the 1970s, we had stagflation, but debt ratios, as I said, were very low, around 100% of GDP. So the stagflation did not lead to a debt crisis. After the global financial crisis, we had a debt crisis because there was high private and public debt. But because that was a demand shock, a credit crunch, following the GFC, we had lowflation, if not deflation. Today, we have the worst of both worlds, because on one side, we have forces that I described on the aggregate demand and aggregate supply going to lead to inflation and stagflation. But compared to the 1970s, where total debt was 100% of GDP, today the number is 400% of GDP. And therefore, if the inflation and stagflation that I worry about were to occur, not only you're going to have inflation, not only you're going to have stagflation, but you could have a severe debt crisis. Many countries are going to go bust, either the public sector or the private sector. Final observation I'll make. If you listen now to the ECB or the Fed tell you, don't worry, if inflation gets out of control, we're going to be tough on inflation. I don't believe them. And I'll give you the following example that is significant. Remember what happened in 2018? The Fed was raising rates, and in December they went from 225 to 250. And they said we're going to go all the way to 325 before we stop. So we're going to normalize. And during the year, they were also doing quantitative tightening. After increasing the base money by 4 trillion during the GFC, they decided, no, we have to run down the balance sheet. That was quantitative tightening. In the fourth quarter of that year, after the Fed decision and during that decision, what happened? The crash in credit markets with the spread of high yield relative to safe assets going from 300 to 900. You had a crash in the CLO market that shut down. The stock market fell by 20%. And guess what? On January 2nd, 2 weeks after the FOMC meeting, Jay Powell, scared, comes and gives a speech. And he says, sorry guys, I was kidding when I said I'm going to raise the Fed funds rate from 250 to 325. I'm going to stop at 250. I was kidding when I said that I'm going to reduce the balance sheet and continue to do quantitative tightening. I was kidding, and they stopped. And 2 months later, because there was a little bit of a problem in the repo market, and because there was a trade war between the US and China, what did they do? They cut the Fed funds rate from 250 to 175, and they started QE through the back door by essentially doing this refunding operation in the repo market. Now, this happened a year before the COVID crisis. And of course, once the COVID started, it didn't take them 3 years. It didn't take them 3 months. It took them 3 weeks to go back to zero rates, negative rates, quantitative easing, credit easing, forward guidance, helicopter drop of money, permanent debt monetization, backstopping of banks, broker-dealer, commercial paper, money market, household, corporates, high grade, high yield. So central banks talk tough, but when you are in a debt trap and the risk is of a financial meltdown when you tighten an economic crash or keep on monetizing, the path of least resistance is going to be monetizing. That's why we're going to end up with inflation and stagflation. Thank you very much.